On January 1st, 2025, the U.S. Mint will suspend all silver bullion production for the first quarter. Officially, it's a supply chain adjustment, but the data says otherwise. American silver stockpiles have quietly collapsed to 50-year lows. The strategic stockpile, once a fortress of raw materials, no longer holds a single ounce of silver. And the largest domestic supplier, the Sunshine Mine in Idaho, hasn't produced in years. Meanwhile, halfway across the world, a very different signal is flashing green. On that same date, January 1st, 2025, China's Ministry of Finance is expected to complete the final phase of a multi-year import expansion plan, specifically for industrial silver. Not gold, not copper, silver. And now imagine, the world's biggest manufacturer of solar panels, electric vehicles, and semiconductors, suddenly sitting on a surplus of the one metal the West can no longer supply. What does that mean? To answer that, we have to strip away the headlines. Beneath every crisis in silver lies a deeper struggle, not over metal, but over monetary systems. Because silver isn't just an industrial commodity. Historically, it's been the other half of money. When gold was king, silver was the people's coin. And every time power shifted in the global economy, silver was either demonetized or weaponized. In 1873, the U.S. demonetized silver, just as Germany abandoned it. Coincidence or coordination? In 1934, Washington seized privately held silver and fixed its price. Weeks later, China, still on a silver standard, suffered a financial collapse. And in 1997, just before the Asian financial crisis, silver futures were shorted to historic lows, while American exporters locked in bulk shipments at artificial prices. The pattern is clear. The shift always starts quietly, with timing, with inventory. And now, once again, the date isn't random. January 1st, the first day of a new accounting cycle, when export quotas reset and monetary policies roll over. China chooses it for a reason, not because it's symbolic, but because it's strategic. In plain sight, the silver system is resetting, not through announcements, but through absence. If this opened another side of history for you, comment where you're watching from. To understand why the collapse of U.S. silver supply on January 1st matters, we have to go back, not just decades, but centuries. Because silver has never been merely a metal. It has always been a mirror of power, of policy, of control. For most of recorded history, silver wasn't just money. It was the system. From ancient Athens to Ming China, from Spanish galleons to American frontier towns, silver coins moved trade, paid soldiers, and settled empires' debts. Gold was hoarded, silver circulated. But in the 19th century, something shifted, fast. The 1870s saw a coordinated retreat from silver by industrializing powers. First, Germany, flush with gold from the Franco-Prussian War, dropped silver as a monetary base. The move rippled instantly. Austria, the Netherlands, the Scandinavian countries all followed. And in 1873, the United States passed a single, quiet law, the Coinage Act. It removed the legal tender status of silver dollars, effectively demonetizing silver overnight. Historians would later call it the crime of 73. Why? The surface logic was modernization, stability. Gold was scarce, deflationary, and backed global trust. But underneath that, something more fundamental was happening. Silver made money accessible to the masses, miners, farmers, exporters. It decentralized credit. In contrast, gold compressed monetary power into the hands of central banks and creditor elites. So when silver was removed from the system, liquidity dried up. Farmers defaulted. Railroads collapsed. Within 2 years, the U.S. faced its worst depression until the 1930s. And what did Washington do? It doubled down. In 1893, during another crisis, President Cleveland repealed the Sherman Silver Purchase Act, removing mandatory federal silver purchases. The official reason? Protect gold reserves. The actual result? Collapse of silver prices, collapse of Western banks, and the rise of populist fury. The point is this. Every time silver disappeared from the monetary architecture, someone paid the price. But it was never the policymakers. It was the holders, the producers, the nations still reliant on physical metal. Now fast forward to the 20th century. In the 1930s, the United States seized all privately held silver bullion and fixed its price. The justification was industrial demand. The reality? Silver flowed eastward, to India, to China, destabilizing their already fragile silver-based economies. By 1935, the Chinese yuan had lost 50% of its purchasing power. Why? Because it was silver-backed, and the U.S. had just monopolized global pricing. Silver, once again, had been turned into a policy weapon. And then came 1944, Bretton Woods, a new monetary order with the U.S. dollar tied to gold, but not silver. Silver was pushed out, quietly, strategically. The International Monetary Fund, created that year, but it recognized gold, not silver, as a reserve asset. China, still trying to rebuild from decades of war, never forgot this exclusion. And today, the People's Bank of China is stockpiling not just gold, but industrial metals, especially silver, not as coins, as strategy, as collateral, as insulation. Because history showed them exactly what happens when the West removes silver from the system. Prices fall, liquidity dries up, and those left holding the metal, without control of the pricing, are cut out of the game. This isn't a matter of nostalgia, it's a blueprint. And if silver is being drained from Western inventories now, it's not just a supply chain story. It's a currency realignment in slow motion. What we're watching is not a shortage, it's a signal. If this gave you a new lens on the past, let me know where you're watching from. On paper, the US has no silver problem. Futures contracts continue trading, coins are still minted, warehouses report adequate reserves. But step outside the numbers, and the contradictions start to appear. In 2023, the U.S. Mint announced it would cut back American Silver Eagle production due to supply issues. That seemed odd. Silver is traded globally, prices were stable, refineries were running, and yet, the most powerful mint in the world couldn't secure enough blanks to meet domestic demand. At the same time, COMEX inventories, the physical stockpiles behind U.S. silver futures, began to fall, slowly, then sharply, from over 150 million ounces in 2021 to under 35 million by late 2024. Most of what remained was already spoken for, registered for delivery, or leased out under unreported contracts. And here's the core contradiction. The U.S. is the world's second largest silver consumer, but it produces less than 5% of its annual needs. For every ounce mined domestically, 3 more must be imported, recycled, or drawn down from reserves. That's a fragile equation, especially when imports are falling, recycling is flat, and reserves have been quietly exhausted. The last known silver bars held by the U.S. Defense Logistics Agency were sold off in 2004. Since then, there has been no strategic silver stockpile. None. Only commercial inventories remain, held by banks, refiners, ETFs. But those inventories serve private interests, not national policy. And that exposes a fundamental flaw in the system. Because for decades, U.S. silver supply has relied not on production, but on liquidity. The assumption was simple. So long as we can buy, we don't need to mine. But that only works if someone's willing to sell. Enter 2022. India suddenly becomes the world's largest silver importer, buying over 9,000 metric tons in a single year. Not for jewelry, not for trade, for stocking. By 2023, China joins in, not just through commercial demand, but direct central planning. The Shanghai Futures Exchange doubles its physical silver deliveries. National industrial projects increase silver consumption across solar, electronics, and battery sectors, and private purchases, off-exchange, begin to surge. The result? Physical silver starts moving east, quietly, in bulk. U.S. refiners begin reporting delivery delays. Premiums over spot prices rise. The market becomes bifurcated. Paper silver stays flat while physical silver grows scarce. This is the point of rupture. Because while the price says silver is plentiful, the behavior of governments and institutions says the opposite. And history shows what happens when that gap widens. In 1967, during the final days of the London gold pool, central banks continued claiming that gold was $35 an ounce. But in the background, they were buying it at $38, then $42. The official price stayed fixed until it shattered. That was the end of the Bretton Woods system. Today, silver is tracing the same path. Official prices do not reflect real-world access. The disconnect is growing, and there's no mechanism to correct it because the U.S. doesn't control the flow anymore. China does. With massive state-owned purchases, a captive refining ecosystem, and a central bank capable of absorbing supply without disclosure, China has effectively cornered a market without declaring it. And then comes the date, January 1st, 2025. The U.S. Mint halts bullion production. Not gold, only silver. Officially, it's a temporary measure, but industry insiders say the blanks simply aren't there. Suppliers can't deliver, refiners can't source, and still the market price does not move, because the futures system is intact, but the metal is not. This is the moment when confidence splits from reality. The supply is collapsing, but the supply is being maintained. So now the question is no longer if the system is broken. The question is, who breaks the silence first? If this made something click for you, tell me where you're watching from. Silver isn't just vanishing. It's being arbitraged out of the system. To understand how, we need to examine the pipes, the hidden mechanisms that move metal across borders, contracts, and currencies. Start with COMEX, the U.S. futures market for silver. For decades, it has set the global reference price, not through physical exchange, but through paper, contracts promising delivery, rarely executed. In theory, anyone holding a futures contract can demand delivery. In practice, fewer than 1% ever do. The rest settle in cash or roll over. The system assumes confidence. That metal could be delivered, even if no one ever asks. But in the last 24 months, the pattern changed. Large industrial users, especially in Asia, began requesting physical delivery, in volume. Some pulled directly from COMEX, others exploited loopholes via London, Zurich, and Dubai. The effect was the same. Actual ounces began leaving the system. And here's the critical point. For every physical ounce withdrawn, dozens of paper contracts remained. The structure is fractional, by design. If everyone asked for delivery, the system would default instantly. Let's quantify it. In late 2024, COMEX had under 35 million ounces of registered silver ready for delivery. But the total open interest in futures contracts represented over 700 million ounces. That's a leverage ratio of 20 to 1. In banking, such a mismatch would trigger regulatory alarm. In commodities, it's standard practice, but it only works while trust holds, while no one tests the ratio. China, it seems, has been testing. Over the past 5 years, the Shanghai Futures Exchange expanded physical delivery options, built parallel pricing mechanisms, and encouraged domestic settlement in yuan. In essence, it created an exit ramp from the COMEX LBMA pricing model and backed it with physical silver. Now add the trade routes. Between 2020 and 2024, silver exports from Switzerland to China increased 600%. Similar patterns emerged in Turkey, Kazakhstan, even Poland. Not traditional bullion hubs, but transit points. The mechanism? Refiners, incentivized by higher premiums in the East, began selling directly to Asian buyers, bypassing Western institutions altogether. These transactions never touched the COMEX, never registered in ETF flows, but drained real metal from the system. Meanwhile, U.S. mints and fabricators faced a growing dilemma. They couldn't meet demand at official prices. Premiums rose, inventories thinned, delivery times stretched from days to weeks. And still, the spot price remained artificially calm because the future system didn't reflect physical strain. This is the heart of the mechanism. Silver flows like water. It moves to where pricing is real, margins are stable, and politics are aligned. In 2024, that was no longer New York, it was Shanghai. And here's the paradox. The more the U.S. relies on futures to control silver's narrative, the less silver it controls. The market has decoupled. The leverage remains, but the metal is gone. The system still functions, but it floats on absence. And now, with the mint halting production, that absence is no longer theoretical. It's visible, it's dated, it's official. Every mechanism, when stretched far enough, reveals its design. If this brought the hidden system into focus, share where you're watching from. The structure held until it didn't. By early 2025, the cracks had turned into fractures. U.S. bullion dealers, who once promised 3-day delivery, began quoting 4 to 6 weeks. Premiums on American Silver Eagles surged 70% above spot. Industrial users in electronics and solar manufacturing quietly revised their forecasts, not because silver prices exploded, but because the metal no longer arrived on time. It wasn't just a supply problem, it was a sequencing problem. Silver flows in cycles: mined, refined, sold, fabricated. Delay one step and the others seize up. And when upstream refiners in Canada and Mexico couldn't source reliable feedstock, U.S. coinage and industrial production started missing targets. Meanwhile, recyclers didn't fill the gap. Silver recycling is price sensitive. It responds to spikes. But prices hadn't spiked, yet. They were suppressed by the weight of paper contracts still trading in high volume. That stability, real or fake, muted the price signal, and with it the incentive to sell. But the buyers didn't wait. Between February and March 2025, Chinese state-owned enterprises signed a series of long-term supply agreements across South America and Africa. Exclusive, prepaid, in yuan. That was the tell. In normal markets, supply is available to the highest bidder, but these contracts weren't open tenders. They were bilateral deals, settled outside of dollar frameworks. And here, the monetary consequence became unavoidable, because for over a century, commodities were priced in dollars, not just for convenience, but for control. If the dollar sets the price, the issuer of dollars controls global cost structures. That leverage shaped everything from oil to wheat to lithium. Silver was no exception, until now. With China locking in physical flow and offering local currencies, producers no longer needed to pass through New York or London. The price discovery function began to shift, quietly, permanently. In Western ETFs, they drained. By mid-2025, holdings in SLV, once the world's largest silver-backed fund, had fallen 40% from their peak. On paper, investors sold, but the redemptions didn't return cash to the market. They moved metal to vaults in Singapore and Hong Kong. Why? Because institutions, especially in Asia, were converting paper claims into physical assets. It wasn't a trade, it was an exit. And beneath that exodus lies a deeper truth. Silver in the 21st century is no longer a passive asset. It's becoming a strategic reserve. Governments are treating it as insurance, not just against inflation, but against exclusion. Because the next financial crisis may not be one of banks failing, but systems dividing. And the cost? It won't appear in headlines. It will show up in delayed deliveries, in missed export quotas, in factories forced to redesign for scarcity. It will show up in price spikes too late to act on, and by then, the architecture will have changed. Because once a physical market disconnects from its pricing mechanism, trust doesn't recover. It migrates, and now it has. If this revealed what prices alone don't show, tell me where you're watching from. History doesn't repeat, but in silver, it rehearses. In 1934, the United States fixed silver prices by decree and drained global supply to stabilize its own economy. In 2025, it isn't setting the price, but it's still shaping the illusion. The illusion that supply is normal, that the market is liquid, that the system holds. But beneath the surface, the same mechanism is unraveling, quietly, logically. Then it was called the Silver Purchase Act. Today, it's called ETF redemptions, temporary mint halts, and inventory restocking. The language is modern, the structure is not. And once again, China is on the other side. Let's draw the line. In the 1930s, China's economy was silver-based. The yuan was backed by real metal. When the U.S. began hoarding silver under Roosevelt, global prices spiked by over 300% in 2 years. That rise devastated China's money supply. Silver drained out. The currency collapsed. And by 1935, Beijing had no choice but to abandon the silver standard. It wasn't a war. It wasn't sabotage. It was monetary asymmetry. One nation with pricing power, won without. Today, the polarity has reversed. China, not the US, is now the dominant industrial consumer of silver. It produces over 100 million solar panels per month, each containing a measurable amount of silver. Its EV industry leads global volume. Its 5G and semiconductor sectors are expanding rapidly, all silver dependent. But it's not just about use, it's about access. While the West relies on futures, ETFs, and imports, China has built redundancy, domestic mining, state-controlled refining, long-term contracts, and now currency incentives for exporters willing to settle in yuan rather than dollars. And there's the key. Silver is being used to test a broader idea that strategic materials, not just gold, but usable metals, can be priced and moved outside the dollar system. The pilot project? Silver. Why? Because unlike gold, silver has real-world turnover. It's consumed, not just stored. That makes it more urgent, more difficult to fake, and more revealing. If the dollar system can't supply real silver when demanded, then what does it truly control? This is the modern test, and signs are everywhere. In 2022, LBMA vaults began leaking silver at a pace of 1,000 tons per month. By 2024, premiums on physical bars exceeded 50% in parts of Asia. Major mints in Australia and Europe introduced waiting lists, and delivery times for commercial contracts quietly lengthened, even as spot prices stayed flat. That's not a market imbalance. That's a system in denial. Because the structure we've inherited, futures first, metal later, was never built for scarcity. It was built for confidence, for abundance. But now, we've hit the threshold. Scarcity isn't coming, it's here. And just like in the 1930s, silver is becoming the fault line between financial illusion and industrial reality. The West still sets the price, but the East holds the metal. Then it was America draining Asia. Now it's Asia draining the West. And as physical silver slips quietly out of Western vaults to places where contracts don't matter, only delivery does, the message is unmistakable. The shift is already underway. It's not explosive. It's gravitational. And by the time the West realizes what's missing, the center of monetary gravity will have already moved. In history, collapse never looks like a headline. It looks like routine. A paused production line, a missed delivery, a quiet change in inventory reporting. That's how systems end, not with noise, but with silence. Silver has always signaled these shifts, not because it's rare, but because it's real. It has weight. It can't be printed. It can't be promised without consequence. And now, it's gone missing from the shelves of the very system that once monopolized its price. January 1st wasn't chosen randomly. It was the quiet beginning of a new accounting era, not just for the US Mint, but for a much larger shift in global trust. Because when the metal moves, meaning follows. China understood this before it happened. They didn't fight the dollar, they moved around it. Not with speeches, but with shipments. And that's the story. Not of collapse, but of rearrangement. Not of failure, but of substitution. History doesn't repeat. It waits for us to forget which part we played last time.